Well, good morning and welcome to London and another FS Club webinar. And we're delighted today to be talking about impact investing, the future. And we're here today with Sarah Gordon, who's the Chief Executive Officer of the Impact Investing Institute. Now, you'll know me, I'm Michael Mainelli, I'm one of the directors of Zien, and it really is a privilege to be able to introduce so many of these fascinating webinars. And I can only do so thanks to the generosity and, dare I say, the tolerance of our sponsors, who allow us to range widely and freely across technology, economics, and finance. And today is going to be fascinating in many ways because we're seeing here where finance meets a social purpose. So those of you who thought impact investing might have been something to do with investing against asteroids, no, we're going to be exploring today different forms of impact investing and how really finance can make a social difference. Now, my job is to get out of the way as quickly as possible so that you can hear from our expert, Sarah, and I'll do so in just a moment. If I can make three quick announcements. Firstly, the slides are available. In fact, they're already available up on the website, but do follow us here. Secondly, yes, there will be a recording. The recording will be going up in approximately 2 working days, so sometime about midday on Wednesday, I anticipate. And finally, yes, we really want some vibrant question and answers, particularly about impact investing, which I'll be frank, I've had a lot of trouble getting my head around these last 15 years since it was first mooted to me. There's something very deep here and something very important, but let's make sure that we get a grip on it. So do ask questions and don't be afraid to be fairly direct or whatever you think will help you understand it better. However, please do use the GoToWebinar question and answer facility because I'm here with you, and so WhatsApps and emails and all sorts of other various forms of communication will function perfectly, but they won't get your questions in on time. So please do use the GoToWebinar facility. All of your questions and comments will be sent to Sarah. So if there's some detail or you'd like some follow-up, she will have the questions and comments with your email attached and be able to respond to you. So if you want to contact her in any way, again, just throw a question, comment, or observation in. Well, I think that's plenty of background there. Sarah, we're really delighted you're here. The floor is yours.
Thank you very much, Michael, and it's absolutely lovely to be here. Really grateful for the chance to talk to the FS Club and to you today. So as you said, I'm the Chief Executive of the Impact Investing Institute, and we're a relatively new organisation. We were launched in November 2019, which of course, given the pandemic, seems about 2 centuries ago rather than a year and a half ago. But we're a new organisation. We have a mission to grow the impact investing market in the UK and internationally. Thank you, Michael. We want to see more capital contributing to the well-being of people and the planet, and we have a framing of the United Nations Sustainable Development Goals, but really we're about mobilising more private sector capital at scale, and we want to really address the need for the financial system to be fairer and better for people and the planet. So we're about changing the way finance works, as well as promoting the impact investing market itself. So we have a wide-ranging programme. Really, we address the hurdles that people experience to investing with impact, which ranges from basic understanding. So we do a lot of work across awareness raising and education. We also provide tools and information to help investors and individuals and public policymakers engage with impact investment. And we have a big focus on policy and advocacy. And what we've spent a lot of time doing over the last year and a half is busting some of the myths around impact investing. And with that in mind, I'd like to start with a poll, please, Michael, if that's possible. I'll hand over to you.
That's fantastic. So Sarah's like to ask all of you out there, do you think impact investment is A, only for philanthropists, B, a niche asset class, C, a way to get private capital to deliver public policy, or D, a lens that will ultimately be applied to all investments? Well, one of the great things there is it's a very fast and opinionated audience, and over half of them have voted in just 15 seconds. I'm going to leave the poll open. We're up to 3/4 of the audience now, and while a few laggards are just coming in, we're well up to 90%, and I'm going to close the poll and show everyone the results. So here are the results. So basically, as you can see here, 76% do believe it will be a lens that will ultimately be applied to all investments. So you've got overwhelming audience support here, I think.
That's incredibly interesting. I mean, I really do think that even a couple of years ago, if I'd asked that question of an audience like this, I think there would have been, we would have had far more of a balance of people saying things like it's not really delivering impact is for policymakers, it's not for the financial services sector to do that. You'd have had people far more thinking that impact investment was a niche asset class rather than an approach. So I think that actually gives an incredibly good indication of how the momentum behind this work and this concept, and the way that the understanding of what it can deliver is really moving incredibly fast. So for us, impact investment is investment made with the intention to generate positive, measurable social and environmental impact alongside a financial return. And the reason that I'm giving you the definition slide and really focusing on the different elements of that explanation is because all of them are important. Probably the biggest myth about impact investment, if we could possibly go to the next slide, is around the fact that many people and a lot of financial advisors and asset managers still really believe that any impact investment there has to be a concessionary element in it, i.e. you cannot deliver positive, measurable social and environmental benefit as well as a market competitive financial return. And I thought it would be helpful just to talk to you about where we see impact investing sitting on the spectrum of capital, which you can see here. Traditional investment really is just about seeking competitive risk-adjusted financial return. I think it is relatively rare nowadays to find an asset owner or asset manager who doesn't now also apply an ESG lens, at the very least, or as a risk mitigation lens as much as anything else. But we're really moving into the intentionality of delivering positive benefit. But we are in what's called the finance first impact investing space, where we're wanting to deliver that impact alongside a market competitive financial return. And we have a real focus on the bigger pools of capital that focus on that finance first impact investing. It's not philanthropy plus. Impact investment is not only for philanthropists. And we're building a really extensive evidence base of impact investment across asset classes, sectors, and geographies. If I could have the next slide, please. I mean, one of the things we found, and I'm sure this will resonate with the audience, is that it's not great when we, the Institute, say you should think about impact investing. Impact investing can deliver a market competitive financial return. What we're doing is building an evidence base that actually demonstrates that that is the case, that shows investors across sectors, across asset classes, across geographies, what kind of risk return impact profile you can consider across a whole range of different investments. So we've just published a really, I think it's a really great report on place-based impact investment in the UK. Obviously, a lot of impact, if you really think about it, it's in places. It's often in the places that have historically been underserved by institutional investors. And we've looked at particularly at what local government pension schemes, which have a history of investing in and around the geographies and the communities that they come from. They have a history of that kind of place-based impact investment, what sort of risk and return they're looking at. We're about to publish a piece on social housing in the UK. For many people, the first way into impact or thinking about impact is through the asset classes of energy and housing, because rare is the large asset owner or asset manager who hasn't thought about property or hasn't thought real estate or hasn't thought about the energy sector. So it's often not just a sort of more familiar asset class, but also one where you can find investments at the sort of scale that many institutional investors need to consider. And then we've also looked at impact investing opportunities in emerging markets, specifically at a range of pension funds, not just UK, but international pension fund investments in impact investments in emerging markets. And as I say, demonstrating across a whole range of different types of investments in those markets, how you can deliver a competitive financial return alongside the impact. So we think, I mean, to delve a bit more into what the sort of impact is that we're seeking to deliver with the impact investment approach, is it's not just acting to avoid harm. That's the sort of risk mitigation, in a sense, lens. It's benefiting stakeholders, and it's also contributing to solutions. And this, I'm sorry, it's a rather busy slide, but Michael told me that as an audience you appreciate busy slides. But this gives you a sense really of how you can think about how you can dissect some of that impact in those different buckets. So, you know, what kind of signals you should be looking for, not just from the asset you're investing in, but also you yourself as an investor or an asset owner, where you should be engaging, how you should be engaging, and around which topics. And I think, you know, one of the things that we found in the last year and a half, and I've been doing this job now for 2 years, but I think the pandemic combined with the climate crisis has really combined to give people a very much needed sense of urgency around these sorts of impacts and the role of private sector capital in delivering that positive impact. I think the pandemic made it extremely clear that the sort of fault lines that it laid bare, particularly in social inequalities, so access to healthcare, decent housing, how those sort of social inequalities actually magnified and amplified the very, very devastating consequences of the pandemic. So we really see investment not just delivering a benefit, but really contributing to solutions to these, both to these challenges like inequality, but also how that melds into the investment that can also address the climate emergency. So if I turn to the next slide, please. Impact investors have a range of motives, both personal and financial. And there was an article in the FT last week written by a former colleague of mine. I was a journalist at the FT for many years before doing this gig. And he said that ESG investment is about making the world a better place. And I felt very frustrated by that, because I think those of us who think very actively about ESG and impact know that the market and market understanding of impact has become so much more sophisticated than that. I mean, it is, I would argue, the right thing to do impact investing, but it's also, it makes financial sense. Mark Carney, who, as you will all know, is the former governor of the Bank of England and now advising both the UN and the UK on the forthcoming COP26 conference this November, he says that the climate emergency has created, if not a great, and if not the greatest, commercial opportunity of our time. And of course, that it's a slightly jarring statement in some ways to think about making money out of addressing inequality, for example, but that is the reality. And when we believe that long-term sustainable companies are the only ones that will deliver sustainable profit streams, that's going to be a mixture of regulation and policymakers and individual investors and institutional investors' choices all pushing that momentum. But that is the way that the market is going. And just to finish on the definition, all investments have an impact, all businesses have an impact. Where I spoke in the early days of the Institute to a large FTSE 100 pension scheme, and one of their consultants said to me, but we already do impact investment. We invest in student housing, so we're already delivering that impact. And I said to him, well, are you measuring that impact? Do you know what the impact is? Are you holding yourself accountable for the impact? And to us, those dimensions of impact investment are incredibly important. You may well be delivering positive or indeed negative impact as a business with your operations or as an investment or an investor, but you need to be conscious and account for that impact. And I think that's the way that the accounting system globally is moving as well. It's moving far more to businesses in particular having to account for their positive and negative impact. And we will see, and we all are indeed already seeing, investors punishing companies which are not accounting for their negative impacts and not adapting their operational responses as a result of that. So if we just move to the next slide, please. I think this just gives you a breakdown really of the range of impact investments across asset classes. As obviously this audience already understands, impact is a lens that you can use on any asset class. We've seen at the moment the breakdown of global impact investment. This is work done by the Global Impact Investors Network. And it's, as you can see, we now have a full range of impact. I think there are really interesting debates to be had about what kind of impact you deliver in those different asset classes. And it is different. I think the impact you deliver in a listed asset is different from the one you deliver in a privately owned, in a private market asset. It is likely to be more around shareholder engagement in public equity, because obviously your asset is being traded in the secondary market. You're not delivering, you're not responsible for investing in a company that's delivering impact on the ground. But we can perhaps explore that in more detail in the Q&A if that's of interest. If we just moved quickly to the next slide, please. I mean, one of the things that I spoke earlier about the momentum behind this this approach, and I think that the pandemic really has speeded up that momentum. It's not the only thing. There's increased sort of, the activism of younger generations is something that I think it's very thrilling to see, because I think younger people feel more empowered with their money than perhaps older generations, perhaps in the UK, felt. And I think that we need to empower them more so that they fully understand and can deliver the kind of impact they want, can make a choice about the impact they deliver with their money, whether it's consumer spending or their pension or their retail choices. But what you've seen over the last year and a half is a really staggering rise in the growth in the impact investing market. You've seen record inflows into ESG, into impact, and it's really, I think that reflects both some of the economic consequences of the pandemic. So, for example, the negative effect on share prices in the airline industry and in the energy sector are not particularly surprising. But I think overall you are seeing the conversations around ESG and impact, both at an individual level and an investor level, they're taking place. They're far more important, and that's reflected in the growth of the market itself. So I think it's the poll, our second poll next. Yes, back to Michael.
It is indeed a second poll. So, folks, the question is: do you think impact investing is worthwhile? And A, yes, it has real value. B, no, it distracts from the purpose of investment, which is to generate financial return. C, no, it leads to greenwashing or other unintended consequences. Or D, only in a limited and specific way. And yet again, our audience is very quick on the buzzers here. I think they should be on various talk shows, quiz show contests. Up to 3/4 of the audience have voted. I'm going to hold it open just for a few more seconds while some of them are thinking. And I'm going to close that poll and show the results. And here we are. And 73%, yes, it has real value. 24% only a limited and specific way. So nobody agreeing that it distracts or leads to greenwashing, on 2%. So fairly strong support. Again, I wonder if we're leading the witnesses here a little bit, but we'll come back to some of the challenges here in a moment.
Yeah, that's the benefit of designing the polls, Michael. But I think the fact that, highlighting the unintended consequences and the potentially only limited and specific nature of impact investing is actually very important and does highlight a number of challenges. I mean, we need to have a far greater, I mean, if you asked a group of, perhaps not this audience, but a group of 10 people in the street what impact investment was, I still think that you would have at least half, probably more, say that they didn't really understand what it was. So there is still a really important basic education and awareness raising exercise that needs to continue, and it needs to be integrated into the more mainstream financial sector qualifications and education and training. And we have a learning hub on our website, which is a sort of one-stop shop of information which covers the what and the why and the how of impact investment. But it's either for people's personal interest or to support their conversations with clients or for them to learn more. So I would urge you to look at it, and if you also feel that this is it's important for more people to understand, spread the word about it. I think there is a really big challenge, and I mean, for me personally, it's been absolutely fascinating to see how fast things have moved in the last year and a half. Currently, we have no global standards for reporting and measuring impact, and this is often cited by investors, both individuals and institutional investors, as a real hurdle for them in either launching impact funds, engaging with impact, reporting back to clients. And it's a very real problem. At the moment, you can call anything impact, you can call anything ESG, but what is, and you've got an absolute plethora of sort of competing commercial and non-commercial initiatives with what the FT calls an alphabet soup of ESG metrics. However, there is some really positive stuff happening here. The IFRS Foundation, which oversees international financial reporting standards, is going to launch probably later this year a global sustainability standards board, which will really be the first step in providing those international frameworks so that reporting and measuring can converge. And I think that's going to be incredibly useful. I think there are some limitations to what the IFRS is considering doing at this stage. There's to us, a very narrow focus on climate and the environment rather than more broad social issues. And I think there's likely to be a big focus on factors, you reporting as a business, on an investor, on factors which are material to you, rather than your impact on wider stakeholders. But I'm aware of the clock ticking away, so we can get into that in more detail if that's of interest to the audience. I think, I referred to one of the dangers at the IFRS, but I think the danger of the E drowning out the S in ESG is a real, it's a challenge. I mean, it's great that the UK is hosting COP26 this year, but we have to make sure that the E and the S are considered together. And we think very much in terms of a just transition, in terms of enabling a transition to net zero, which is socially just and which provides opportunities for people, as well as addressing the challenges of that transition. If we can quickly go to the next slide, please. This is an example of the Green Jobs Challenge Fund. You can maybe have a bit more closer look at it later if it's if you want to delve into the detail. But this is an example of a type of investment where you're delivering both environmental and social benefit. So you're working, the money is going towards creating, empowering people with those skills, those environmental related skills that are going to be absolutely critical to the future success of the UK economy. And we are talking to the UK government, and have been for a while, supporting them in how they think through the challenge of delivering social as well as environmental benefit with programs like the Green Gilt, the framework for which is going to be announced tomorrow, which is very exciting, and the Green Retail Savings Bond, which National Savings and Investment is going to issue later this year. If we quickly go on, please. So yes, we can move to the next slide, actually. Thank you very much. So we've seen this explosion in green bond issuance, and this really is a moment of incredibly important transition. There is momentum, but we really need a collective mindset so that both at every level, public policymakers, regulators, investors, individuals, we are all pushing in the same way for the greater mobilisation of private sector capital. And impact investing is not the only answer, and it's only part of the solution. It's only part of the way to address the many challenges that we face as a society, as a globe. But it is definitely, I think impact investing is going to be the future. It's going to be the only way we invest. I think businesses are going to be held accountable, both in their balance sheet and by investors, for the positive and negative impacts that they deliver. I think that investors, whether institutional or individual, are already becoming increasingly sensitized and aware of the importance of this approach. And I think that's only going to grow. So I've gone 1 minute over, Michael, but I will stop there so we can leave plenty of time for Q&A.
Well, it's been absolutely fascinating. We got a lot of comments and questions, and do keep them coming in. In fact, I'll just read one out that I thought was quite spot on. This is from Deborah Webster, who I believe might be dialing in from the Gulf. In reality, every investor invests in impact. Just a lot of it is negative impact. So, very interesting point there. Just quickly, going back to your Green Jobs Challenge Fund, could you just explain, how this is an investment and not just a fund to spend money? Where's the revenues coming from to repay that fund?
Well, this is a government fund, so it's not an actual investment. It's for use of proceeds, potentially for the green gilt. It's also something that the new UK Infrastructure Bank is thinking about as it develops its mandate, and we're very excited about the UK Infrastructure Bank, because I think it's got the potential, with a strong enough mandate and a strong enough commitment, to deliver some of this just transition outcomes financing that is so badly needed. I mean, what you often need in particularly in levelling up, sorry to use the phrase, but levelling up regional inequalities is there is often often a role for concessionary capital of one form or another. And what we see a lot of potential with the UK Infrastructure Bank, for example, is directing first, for example, providing first loss capital, or at least the first layer of capital, maybe grant funding for some of to get the market moving. And the Green Investment Bank did a lot of that in renewable energy and wind in particular, but it was at a smaller scale than the National Infrastructure Bank, and with a less broad mandate. So we're really hopeful about that. I should just, can I quickly come back to the first point from, was it Deborah Webster that you mentioned? I mean, there are some really exciting developments in that area, where a lot of work being done around how you can account numerically for your positive and negative impact, and I think we will see. There will be, the direction of travel is towards merged financial accounts, where you report your impact is into your negative and positive impact are integrated into your financial performance data in a way that isn't happening at the moment. I think one of the debates is how quickly we need to get there, because we know, for example, with the climate crisis, we need to do this now, not tomorrow, not in a decade. And the accounting world does not move fast. However, there is on the standard side, the IFRS has moved incredibly fast compared to history, and I think we will move we've got at the moment separate. You account for your impact in a separate way from your financial performance. I think we need to get a bit better at accounting for the impact, but then I think that the final stage will be integrating that within you'll have one balance sheet, one P&L, and your impact will be lines or more than one line in those.
Great. We've got quite a few here, so might want to just speed up a little bit. This is a question you must get quite often, I think. It's from Bob McDowell, who's out in the Channel Islands. Where does impact investment end and charitable giving begin?
Well, there's a real blending. I showed you on the spectrum of capital where, philanthropy, pure philanthropy, you are talking about a 100% no return on your capital whatsoever in return for the impact that you want to deliver. And in impact investment, we are talking about financial return. So that's the simple distinction. But I think you are increasingly seeing a blurring and a lot of very interesting activity on the on the intersection between philanthropy and investment, where, for example, the Rockefeller Foundation, has just it's raised money in the corporate bond market for the first time, which is incredibly interesting. But it's using grant capital as that catalytic layer to crowd in more private sector capital. So I think philanthropy has an incredibly important role, and individual philanthropists and foundations are also very interested in the impact investment space and getting increasingly involved, because you don't just want to be delivering impact with your grant, you also should be thinking about the impact of your endowment and how you manage your endowment.
Bob, again, is impact investing, you mentioned long-term, and this is kind of a long-term theme that you can buy into, as I think a number of us have frequently sold long-term climate stuff. If that's the world that we're going to be in, it doesn't matter, it's going to get there. But is impact investing short-term in the sense of 5 years, medium, beyond 10, or is time frame irrelevant?
I don't think time frame is ever irrelevant. I think there is one of the reasons that we focused very much on pension funds in our first year and a half is because we think there is a natural alignment between the sort of time periods that pension and the sort of longevity of pension funds and the returns that they need to deliver and impact investing. Because yes, in some asset classes where you're delivering impact, you are talking about long-term cash flows and long-term impact. But that's not to say that you can't consider your impact in a much shorter term way. I think one of the really interesting things in the debate around the government's green gilt programme is what sort of period you should commit to. Should you commit to spending the proceeds in 10 years or in 5 years or in 3 years? And there's there needs to be a good alignment between what the appetite that institutional investors have for these impact assets, i.e. what the market is prepared to tolerate and what clients want, as well as what the policy or other impact needs that you're answering. So I could give more examples, but I think across the asset classes, you've got a whole range of time periods that you can consider.
Now, you mentioned that clearly one of the challenges is standards. This month, we published a pamphleteer from Jill Ringland and Patricia Lustig, which really pokes some very serious holes in the ESG standards, with people in one rating system, the other. You referred to the FT's alphabet soup. As an economist reader, I'll refer to the fact that the Economist also called it an alphabet soup of ESG out there. And I've got a lot of comments here, so I'll just read a few so you get the flavor, and then I'll point the question. So Robert Woodthorpe Brown is curious about, will there be a kite mark to avoid greenwashing, and where's biodiversity fit? Deborah Webster again, isn't the lack of agreed standards a convenient excuse for investors? They are all, after all, some of the smartest people around. Seems like intellectual dishonesty. Cormac Petit, how do you prevent measurement standards leading to herd behavior, which can negate the desired impact? And there are quite a few more out there. So is it possible to create this standard, or should we just be poking away at it? And if it is possible to create a standard, how are we going to avoid some of the problems that we've seen, for example, most recently with the EU's issuance of its standard on the environment, causing more problems in many ways, and then the British response of saying, "Oh, we're going to bring out yet another standard." So, are we just in danger of losing the plot here?
Well, I think, specifically on that last point, I think that I really do feel that on this, the EU's heart is in the right place, but as so often with EU, the way it manifests it is not very user friendly. And I think that's what asset managers are really struggling with the green taxonomy, is actually, even if you're really into this and have got lots of products and have been thinking about this for decades, actually how you meld the green taxonomy and what you're doing in real life is really challenging. And one of the things we at the Institute think is, obviously I'm a former FT journalist, so I'm not in favour of Brexit, but one of the advantages and potential opportunities from Brexit is the UK financial services sector and Treasury and BEIS taking advantage of the increased sort of nimbleness and room for manoeuvre we have to develop things that are really user friendly, that people, market participants can actually use. So I think there is an opportunity for the UK around a social taxonomy. There's work already underway on a green taxonomy. I think the lack of standards is incredibly serious and important for this space and for the growth of this approach. I mean, I reported on investors and businesses for nearly 20 years, and I know that regulation and policy always lags the market. It's in the market and with the investors that the innovation and the risk-seeking behaviour is going on, and it always takes time for regulation and policy to catch up. So I think it's not surprising that we're in the place that we are now. However, I think that regulators both nationally and internationally are very aware of the problem, and I think there is there's really swift movement. I think the point that was raised around the difficulty of measuring impact and whether herd behaviour can negate the desired impact is also an incredibly valuable point to raise, because what we don't want to do in the process of providing standards and global norms and allowing people, what you want to deliver is accountability and transparency, so that investors can compare products, can hold businesses and asset managers to account for the impact as well as the return that they deliver. But at the same time, you also don't want to dumb down the whole impact, the range of impacts that you're delivering as a consequence. So I think that the IFRS is right to start with climate and a smaller subset of factors so that we can get those right and then build on them. And I think that's what's going to happen. I also think, what we're trying to do is to help link the policymakers and the regulators to the market, so that some of this is driven by market needs and investors' needs, because too often it isn't.
Robert Merritt, who's a master of the Worshipful Company of International Bankers, is curious, what are some of the key measures that investors should consider using to track the progress of their investments towards positive action?
Well, the UK government was the first government to say that TCFD, so the climate financial disclosure regime, would be mandatory for UK companies by 2025, and for large companies it's going to be by even earlier. So I think around climate there is now a used and usable framework that is available to everybody, that's transparent. Critically, it doesn't cover the biodiversity point that a member of the audience raised in a question that you mentioned earlier, Michael. And there is work underway on financial disclosures around biodiversity. On social impact, things are lagging. It is difficult. There's a whole range of sort of international norms, like around slavery, around human rights, around checks that you can make in your supply chain, but a comprehensive social taxonomy does not yet exist. Now we're trying to help. I mean, the UK government has committed, for example, to reporting on the social co-benefits of its green finance programme, so its green gilt and its national green retail savings bond. And we're really trying to help support the thinking around that, what that actually looks like in practice. So I think that will start providing a national framework for this thinking, but it is very much a work in progress.
Con Keating is curious, how are these investments consistent with the fiduciary duties of pension fund trustees?
It's a very important question. We have a paper on our website developed by our pro bono legal panel, which has now 12 leading law firms in it, which explains why fiduciary duty is not only compatible with pension fund trustees' duties, but it is actually incompatible with their duties not to consider the positive and negative impacts of their investment approach. Very happily share that paper with you. From that, we developed impact investing principles to guide, which are 4 principles to guide conversations at trustee level and others. But this is, I mean, for us with pension funds, this is the key hurdle, that there is it's one of the myths I talked about earlier, that trustees rightly and other fiduciaries rightly believe that they are absolutely wedded to their fiduciary duty, and so they should be, and that belief that your fiduciary duty is not compatible with impact investment is therefore a really basic hurdle to you engaging. So I would urge, I will share that paper and our principles with the audience perhaps later, but really important question to raise.
Super. We've got a few questions really about skills. So Yi-Ting Lee, I'm an accounting student. Do I need to have knowledge about the environment and engineering and all if I want to do ESG investing? Deborah Webster again on, is anybody working on ESG standards for technology, for example, the use and impact of AI? But I think it's Christopher Gleedle who thanks you for a great presentation. But Sarah, you mentioned that many in finance still feel that there must be a concession on returns in impact investing. Do you feel this is due to a lack of the necessary holistic skills and knowledge of financial professionals to see, account for, and drive the opportunities? So I guess in a sense that the audience are kind of curious about thoughts you might have on acquiring the necessary skills, and where do we stop? Because do I have to understand the entire impact on the whole world just to make an investment?
Yeah, I mean, I'll answer first on the question that I don't know the answer to, which is the ESG standards on technology and AI. Really good question, and I will find out the answer to that. On the where do you stop on your understanding of impact, I mean, precisely why we need a social taxonomy, for example, and global standards is so that people, investors, individuals don't have to understand everything. The purpose of regulation, of standards, of reporting norms is precisely to make clear and make transparent the things that you as investors or individuals need to know. So no, we should not all be experts in every element of impact. That said, I mean, financial advisors and consultants, asset managers, asset owners, there is a very broad spectrum of knowledge at the moment around impact, and I think a basic understanding of at least the different buckets in which you can be considering your impact. I mean, one of the things that we suggest to, for example, foundations that are thinking of getting into impact is look at what you're doing already in your portfolio and think about whether you're delivering positive and negative impact already. On the holistic skills and concession, the idea that I think that the market has moved very swiftly. I think that it used to be, impact investment used to be considered a niche approach and a niche asset class, and very focused on private markets. So I think that partly it was partly, the idea that impact investment had to be concessionary was partly because of the state of the market, as well as lack of knowledge. I think you've now got this vast range of products to consider, both in public and private markets, and we're now able to provide the evidence to show that impact investment doesn't have to be concessionary. I mean, there is a role for concessionary capital that I talked about earlier. So I would urge you to look at our Learning Hub as well, again, which does go into all these issues in greater depth, just because I'm aware, Michael, that I know you like to stop on time.
So very quickly, Danish Qatari, where can investors find funds to invest in? Any suggestions?
Well, we don't recommend, we're not financial advisors, we don't recommend particular advice, but I would urge you to go to our website, have a look. I think that'll give you some good pointers.
Great. And a final one, just a short one perhaps, but coming, how is impact investing linked with decentralized finance, or DeFi as it's called? It seems like these two things are massive trends in finance at the minute. They ought to be connected in some way. And I would argue, given the wider issue of ESG, we're going to find a need to interconnect all sorts of things. But any quick thoughts on that?
I agree, and I think delivering impact and investment in place is it requires decentralized financing mechanisms, vehicles, and an approach. But that is where you deliver impact. Yeah, I fully agree, and I would urge you to look at our recent report on place-based impact investment.
Okay. Well, as you say, lots of thanks coming in, which will all be sent to you, and a couple of requests as well for your fiduciary paper, which we'll pick up for sure. And we'll also post that on the website for everybody. So thank you very much for that. Folks, as ever, 3 quick rounds of thanks. Firstly, to our sponsors. If this isn't one of the most interesting and exciting areas of the future, I don't know what is. So the impact of impact investing, I think, has been proven today. I think the second thing I'd like to do is thank the audience. You've been clearly very interested, and I love that. So thanks again for helping lead the discussion where you want it to go. We do have a couple more sessions coming up, a particularly busy Wednesday when we're going to be talking about frauds and pandemics with Michael Levy over from Cardiff, and also on why AI needs another AI. We have Gillian Tett speaking on anthropology intelligence for a change, so that should be exciting as well. But my thanks most of all really have to go to you, Sarah. You've been so kind to come in here from Exmoor and to talk to us today about an area that we really do need to constantly pay attention to. And I think this audience agrees with you that it will be the lens that we'll be looking at everything through in the near future. And we wish you and your institute every best wishes in getting the message out. Unfortunately, in these days of technology, I'm unable to open the floodgates of applause as yet. But I do have my Korean karmic clapper, which serves, I'm afraid, as a bad substitute for an audience that has clearly really enjoyed you being here today and explaining things to us. So thank you.
Thank you very much. It's been a pleasure.